Investing for the short run, you have plenty to choose from. You have 16 kind of debt funds. Besides, you have the bank deposit and the savings bank account. So choose carefully.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, we usually ask you to invest for the long term, but then what about your short-term goals? A new phone, a new car, or a nice holiday somewhere? What should you do? Should you just keep your money in bank account and use it from there? Or are there other options that can get you better returns on your short-term money? We'll talk about that in today's episode. Keep watching.
Highest possible return in the shortest possible time. This is a fancy expectation, and this is likely to be a very popular expectation. And this is something which will make you extremely vulnerable, because the moment you want this highest return in shortest possible time period, you'll be attracted to a set of investment where you are guaranteed to be losing money, more likely to be losing money than making money. And once in a while, you will get the illusion that you are making money. Anything which is too good to be true is unlikely to be true. And that actually gets proven time and again. You should maximize your return over the long run. And you should ensure that you don't lose capital in the short run. And you should be completely risk averse, because short-term goals, you don't want to take chances. The money that you need in 3 months, 3 days time, or 5 days time, or 3 months from now. Money that you can actually take chances with are the ones which you need it after 10 years. And you can well withstand the ups and downs during this period. For short term, don't get attracted to the great returns. Rather ask one very basic question. If you are investing for a goal, is it for a negotiable goal or it is a non-negotiable goal? Your child is getting into school on a specific day and you have kept some money on the side for that. That is something which, you can't negotiate. It must be lying there and it must be there when you need it. So that money should be in a debt fund. That money should be in a bank account, or that money should be in a bank deposit. You make your choice. The difference is not going to be meaningful. Choose the one which you are most comfortable with. And the difference between in return of any vehicle is not going to make a meaningful difference unless that amount for the short term is very sizable. If you are investing for a negotiable goal, assuming that you plan to go on an overseas holiday and you are targeting a sum of something like 10 lakh rupees, and if it is delayed in next 2 years, and if it becomes 2.5 years, it doesn't matter. If it happens little early, you will feel happy. Then maybe take a very limited chance with that money. Maybe invest in a conservative hybrid fund or some such thing, because there is a likelihood that you will get lucky over the next 2-3 years. In the debt mutual fund, you have a wide variety. You have 16 kind of debt funds officially to choose from, open-end debt fund. But your needs are pretty limited. Your needs are that either that money will be for few days to few weeks, or few months, or maybe few years, but you don't want to take chances with that money. And with this in mind, if broadly there are 3 kind of goals of 3 different time frame, your needs will be fulfilled by very well met by a liquid fund, or an ultra short term bond fund, or a short duration fund. The big difference in mutual fund and bank deposit is over ever since the taxation arbitrage, or the way they were treated is gone. I'm hopeful that for a comparable period, the mutual fund will earn you anywhere between 0.5% to 1.5% more than a bank deposit of a comparable period. But most importantly, there is still one advantage. The advantage is of liquidity. In your deposit, you lock your money for a defined time frame. Of course, you can take it out prematurely, but in case of mutual fund, you can take your money back anytime. And one significant advantage with mutual fund is that you invest in a fund and you don't redeem it. You are not liable to pay any tax. You are liable for taxes only when you redeem it and only on the gains. So if you are a long-term depositor as compared to a long-term debt fund investor, your annual return from the bank deposit will be taxed every year, and here in case of debt fund, it will be deferred till you realize it. So if you don't take your money out for next 10 years, you are not likely to pay any taxes.
Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.